I'm Ashton Addison from EventChain for Investment Pitch Media and FinTech News Network. And today on Blockchain Interviews with Keith Dicker, the Chief Investment Officer of IceCap Asset Management. Keith, welcome to the show and thanks for taking the time to be here.
Oh, hi, Ashton. It's great to be here today. So let's have a great conversation.
Yeah, I'm really looking forward to this. I'd love if you could kick off, I know you have a lot of years in the financial industry, but just give us a little bit of your background in finance and your recent focuses at IceCap.
Yeah, sure thing. So I've been in the business now for almost 30 years. So it's been a while, but I started off with one of the big Canadian banks as a portfolio manager, and then I was offshore for about a decade. And when I was offshore, I was running a multi-strategy, multi-currency desk. So it's just a terrific experience. And what was important about that was because when you're offshore, you completely have no home country bias. Mm-hmm. If you don't see the world as a Canadian or see it as an American or Aussie or whatever, you just see it for what it is. And as we get going now, we have a good conversation here, you'll get to see how important that really is. But after 10 years offshore, my family and I came back to Canada, and that's when I launched IceCap Asset Management. So we're based here in Nova Scotia, but we are a complete global macro firm, and we manage long-only portfolios for like any kind of portfolio you can imagine. Mm-hmm. As well as we also manage a hedge fund and a special purpose vehicle. So two of those together, we have investors literally from around the world. And like today is a global macro world. Mm-hmm. We haven't seen this for a long time. Markets move in big secular flows. And I think the conversation about global macro plus crypto, currency, you name it, everything is coming together at this one point in time. And those that can see it, or, they should have a pretty good experience with it. Those that don't see that, they could have something that they're not expecting.
Mm-hmm. Yeah, I really like that perspective, Keith, because there's a lot of people that have been interested in investing in the markets throughout 2020, and it's really easy to just get caught up in what's in North America. And there is a whole global market that many people don't even notice, but the trends, everything affects one another. And there is so much to talk about in terms of the American markets, so I do want to touch on some of that stuff as well. And right now, throughout 2020 at least, the Federal Reserve's been printing more funds because of the pandemic. There's been a stimulus and debt, and with more printing of the dollar comes the potential of inflation or hyperinflation or movements to the dollar. Can you talk about where you see the American dollar standing right now and currently with everything that's happening in the market, how you project it moving?
Yeah, absolutely. Maybe I'll just show you a chart first to give you an idea of what we expect to happen.
That would be great.
Then we could just flow on from there. So let's see here. Is that good with you guys?
That's great.
Okay, so first of all, in the fiat currency world, we expect the dollar to have the opportunity or a very high probability that it can absolutely surge. And the reason for that is not because, the Americans are any better at running their economy or finances than anyone else. It's really a function of the way the global financial system is put together, and it's become completely dependent upon capital flows into and out of the dollar. Mm-hmm. So we believe so strongly in this view that all of our strategies are managed towards that. So for long only, we avoid markets we think will not do very well, and vice versa. Mm-hmm. And but we've also actually set up a fund to benefit specifically from this strong dollar perspective. Mm-hmm. And then in the crypto world, what you see here on the chart, it's really like the next movement beyond the dollar. And so going from left to right, I think what we've already experienced the bond market getting rescued to a mainly degree back in March of this year. But so right now, investors should prepare next for risk to reemerge in the emerging market space. So we have a lot of positions in that space on the short side, specifically Turkey as well as Hong Kong. And then as stress comes out through that market, then you'll see them move into the major currencies, including Canadian dollar for anyone on here from Canada. Then you have yen coming through, and then by that time, there's so much money flowing into the dollar that's really when you get the moment of truth coming up. So anyone who's in crypto or gold for that matter as well, when you see the dollar rise, so that the next tell that we're looking for the market. Just say even if it's next week after the election, when we get a significant surge in the dollar, we want to see what happens with gold and crypto. So if, for example, say, a round number, say everything else is down 10%, just say gold and crypto are flat or down 1 or 2% in that environment relative to the dollar, then that is telling us that, okay, wow, yeah, we're ready for liftoff here. And then that will open opportunities in that space as well. But it's important to recognize, if you're in the global macro space like we are, it's important to see how capital is going to flow from one market to the next. And this is the path that we laid out. And so far it's playing out. And it just so happens the COVID crisis has really started to accelerate this.
Yeah, that's super interesting. And what implications or what effect has the stock market, the equities market in America rising and the increased stimulus had on, now you're saying that the dollar is going to continue strengthening? And some people think that because they're just printing more, then it just equates to a weaker dollar because there's more dollars. So if you could elaborate on that.
Yeah, so so I'll just come back to that in a second. And then the other thing to sort of preface the whole, global macro world, how to really better grasp it. We like to explain it that right now we're getting this collision taking place. So it's a messy world today. So we're getting a collision across social, political, economic, fiscal, and monetary factors. So you just described the monetary factor side of it. The world, some people say the world has gone crazy, it's insane, but there are a lot of unhappy people out there for a number of different reasons, regardless of what your view is towards anything. That is happening at the exact moment in time where we're getting this turn in the financial world. So, most people, if they're studying, the financial history, they're aware of Bretton Woods. And a lot of people say, Bretton Woods collapsed back when the dollar came off the gold standard. There were 5 main decisions from Bretton Woods. So after World War II, all the Allied leaders got together up in New Hampshire, and they created the World Bank, they created the IMF, they pegged all the currency to the dollar, they pegged the dollar to gold. And then the last one that is still standing, it's the only thing that's really still standing, because the World Bank, the IMF, they're largely ineffective today, is that the whole Western world has adopted Keynesian economics to run their economies and central banks. So what that means is that when there's a bad time out there, you're going to lower interest rates, or you're going to borrow and spend more money. So this comes back to so you have that taking place at the exact moment in time when, hey, people are a bit unhappy with different things out there. The reason this is such an incredible moment right now in markets, because as you just mentioned, hey, the Americans, you said they're printing money, but you know what? The Europeans were actually expanding their balance sheet faster than the Americans. The Japanese are already there. The Chinese are doing it from a different perspective. They're just simply increasing credit in their economy. Every central bank in the developed world right now, they're at 0% for overnight rates, or they're negative. And everyone at the same time, they're using QE to try to control the yield curve and things like that. So it's important not to look just at the Americans in isolation. You have to look at everyone together, and it really is now sort of this race to the bottom. And so when you go across a period of, say, 30 years from the early 80s to today, where rates used to be, say, 20%, now down to 0, monetary policy and fiscal policy has now become ineffective. It's impotent. It doesn't work anymore. So we've created this environment where, oh, wow, like if interest rates even go up a smidgen on the long end of the curve, this is completely going to throw someone's finances out of whack. So, for example, in Canada, Canada has spent more money on their deficit this year than any other of the countries combined as a percentage of GDP. Like, it's just astronomical what we've done up here. At the same time, you look in Canada, we're spending as much money on interest expense every year, or a debt burden, that we're spending on healthcare as well as education.
Wow. Yeah.
It's just crazy stuff. So to pick on the U.S. on its own or Canada, it's largely not the correct thing to do. So circling back to your question, then you're talking about equity markets and stuff like that going in. We are asset class agnostic. So in our portfolios, we invest across cash, across currencies, credit, duration, equities, commodities, as well as volatility across any of the markets. We want to allocate where we think we can make money, short other markets we believe will make money that way, or avoid them if it's on the long-only strategies. With what's happened with equities around the world, especially in the U.S. market over the last 7 months, there's been a pretty good disconnect between the real world and then financial markets. And what we're looking at right now in the equity world, we are more cautious than positive, absolutely. In the institutional world language, we're underweight equities, so we're in our hedge fund strategy, we're short equities for some positions in that market. But the rate of recovery now, from an economic perspective, it's slowing. It's starting to roll over. And the big problem that the world is going to run into now very quickly is that all of these temporary losses that originated due to the shutdowns earlier this year, now we have this mad race taking place. The longer we go without a fast recovery, these temporary losses will become permanent losses. And the more permanent losses we have, that's extremely deflationary for the system. So when we look at the whole, what's going on with inflation and stuff like that, inflation can come from 3 different ways. From a supply issue. And we think that, we're headed for a supply issue, especially across some of the commodity spaces over the next 18 months. So we think that is a source of inflation coming up. The demand side is going to be weaker. So that is deflationary. And then the third source of inflation comes from the currency side. So, for example, if you look at Turkey today, their currency is down about 40 to 50% now. And they will be importing inflation into Turkey. So when you come back to balance sheet expansion, does that create inflation? The answer is no. We don't view it that way at all. Inflation is going to be created as soon as foreign investors, they lose confidence in your market and they decide, hey, we're no longer going to buy Canadian debt. All of a sudden, rates start going up, the currency starts coming down, and creates all sorts of problems. So one of the key markets we see coming up for that you want to be long in is volatility markets, especially fixed income. And in terms of on the short side of the marketplace, we are significantly positioned to benefit from stress reemerging in the developing market world.
Yeah, super interesting, Keith. And you talked about a bunch of different countries, but you mentioned Canada as well, having their balance sheet has gone astronomical, and with the interest rates being low, and other countries internationally, they actually have negative interest rates. First of all, do you see that happening in North America? And I guess let's start with that. Is that a possibility, and how does that impact everyday consumers in North America?
It's absolutely coming. So the Bank of Canada, they've already stated we have negative rates in our toolkit. The Japanese are already there. Eurozone is there. You're going to see the entire developed world try to go with negative. Caution everyone though towards the Fed going negative with overnight rates. It's at the moment they do that, they just effectively kill the money market. Market that's out there. That means commercial paper is no longer an effective way to raise capital. So the whole economy shuts down instantly as soon as they do that. So the Fed is extremely reluctant to go negative. If they do, it's that the chart I showed earlier, we're going in that direction. Because remember, when financial conditions deteriorate, money flows into the dollar for safety and protection. Because it's the only market, big enough and deep enough to absorb that capital. But yeah, you can see negative rates go around at overnight rates, as well as you'll see the yield curve go negative. So in the US, you can see the 2-year go negative. That will happen. When that happens, it's not So the reason they're doing that is they're trying to stimulate the economy. That's what they're trying to do. But the Japanese have already proven that, they've had over 20 years of this now, and it ain't stimulating anything in Japan. The Europeans have been, doing a pretty good job at trying to do that now for 8 years, especially, and it's not working there. But it's the classic definition of insanity. They just keep digging and digging and digging, and they just need to stop and say, "Hey, wow, like we're in a hole here. We need to get out of this." So the biggest risk again in the marketplace today, it is not the U.S. So in the developed world, you have to look at the European banking system. The European banking system, it's just clogged with bad loans in the system. They didn't clear things out 10 years ago. It's still on their system. I always chuckle when people talk about European banks being great value because of the price to book. There's a reason for that, because the book value is incorrect. But again, we're in this precarious position where the way to escape out of this, we really do need this escape velocity with growth. If we get increased growth around the world, economic growth, then we can slowly heal our way out of this. At least provide some hope out there in the financial world. So you use Turkey as an example. The central bank now has a negative foreign currency cash position. People say, "What the heck is that?" So what they've had to do to defend their currency, they're selling dollars and they're buying lira back to try to strengthen it. The central bank ran out of US dollars. So then they increased the capital reserve requirements for the commercial banks for foreign currency, which was US dollars. They've taken that from the commercial banks and spent that. So the way for Turkey to recover, the same for everyone else, they need the global economy to grow. That means it's positive net trade, more dollars will come back into their system, and then off we go again. But again, we have the velocity of money; it's just tumbling down. Like this, again, we just cannot stress enough that we're in a pretty difficult position coming up here. So as a money manager perspective, it is what it is. We didn't create it. We think there are a lot of great opportunities to make money, great opportunities to lose money as well. But the better you understand what's happening in this system today and then why it's happening, that should help you out going forward.
Definitely. And we're running out of time, Keith, but I do want to ask one last question about the people that are in North America that, they're not money managers, but they're just everyday working class people and they're trying to stay ahead and preserve their wealth. Do you have any tips or suggestions in what they should follow or what they should pay attention to try and stay ahead as the economy keeps going?
Yeah, I think the main thing for everyone to do, what's great today, because of social media especially, you're able to access some really great managers out there. They're able to share with you, give you something different to look at and think about. But for any investor, whether they're based in the US or Australia, Britain or Canada, don't look at the market from your own home country perspective. You really have to elevate yourself and look around, and you'll say, "Oh wow, things are kind of tricky everywhere right now." And then as soon as you understand how money flows around the world and why, then all of a sudden the clouds move away, then the fog lifts, and you say, "Okay, now I know where this is going to move."
Great advice. And where can other viewers follow your work?
Yeah, so 2 sources. You can visit our website, of course, which is icecapassetmanagement.com. We write frequently, maybe 4 to 6 times a year, and we get from 20,000 plus readers on that. So it's a global macro story flow type conversation, which is pretty popular. And then on Twitter as well, we're pretty active. So that is at IceCap Global.
Great. Well, I will leave those links in the description box below as well. Thanks so much for your time, Keith. I really appreciate you coming on. All the best with IceCap, and let's follow up in the near future.
It's great. Thank you, Ashton. Have a great day.